Hi traders, welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to give you the latest news driving FX markets and some charts to watch from what my charts to watch are. So let's get going then. So it's the first one of the week. There wasn't one yesterday, so we're going to play a little bit of catch up here and have a little look at what's been happening overnight as well as what's been happening towards the end of last week, because what a crazy situation we find ourselves in, especially when it comes to US dollar, Japanese yen. We were talking last week about how this price kept grinding higher, heading towards that October 1968 highs. And we were basically saying, when is this intervention going to come? It was feeling like it wasn't going to come. And we were just talking about a quick strategy that I was using where I was looking at basically shorting every end of day low to try and catch this big move down through here, which is exactly what we did. Ended up taking a short position on this candlestick low in here, stop loss above the high. Now, looking back, I didn't catch this entire move, unfortunately. In fact, I only caught it down to this level in here. Didn't really take my own advice on holding this through a 500 pip drop, unfortunately. However, the market has now moved significantly. This is something that we've been talking about for what felt like ages since we came up into this kind of 162 handle again. And now the market has dropped significantly. We've moved all the way up from that 163.50 handle all the way down to the 155.50s in a matter of days. And we have a very unique situation going on here. We don't just have the fact that the Bank of Japan intervened and they pushed around $59 billion into the market, and they sold $59 billion and bought back Japanese yen, causing this price to come here. But then we also had the US Treasury get involved too, supporting the Japanese yen, which hasn't happened for a very long time. So we've seen a very aggressive move in the pricing here. Now, I've seen a bit of a pullback now. That is to be expected after such a long move in the markets. A pullback is likely, and we might see this continuation of a drive higher in the near term. So when we take a look at what's been happening in terms of the US dollar and have a little look at how the dollar's been pricing itself on the dollar index, we can see that price has broken down through this level of support. We've broken through that 100 spot 50 handle, and we've come all the way down into the 99 spot 50, where we're finding that support. The last time we found support here was the day of the Fed decision, which was Kevin Walsh's first Federal Reserve interest rate decision, where we saw the US dollar rally from. However, times have changed now. The market is now looking for its next catalyst. That next catalyst could be coming towards the end of this week, which is non-farm payrolls, which we'll go over in a different live stream. But for today, for the chart check, we're going to be talking continually about that US dollar yen price. Where is it going to go next? Where could we see some more opportunities in the market? So like I said, last week we had a little look at that 4-hour time frame. We talked about usually once you get that first leg of intervention, there is a second leg that follows, and we had that 160 spot 50 handle acted as a perfect resistance for price to break lower. Now we're seeing that climb again. We're back at 157.70 resistance. We could see a move a little bit higher. I actually don't mind looking at the, if we take, let's say, a market profile from the swing high of the intervention to the swing low of the intervention, we can obviously see that there was a build up of volume coming in, starting around about 158.50 up to 160.50. Now the point of control of that area, of that sort of minor accumulation consolidation area, is at 159.45. So that could be our next level to look at when it comes to US dollar yen prices. If price gets up into that level here, could we see some more selling coming back in, and could we see prices driven back down towards 155.50? Because we have a very unique situation going on here with the US dollar, Japanese yen. At that point as well, The 50 moving average may have caught up with that level too, so it could almost act as a extra confluence that price could be rejecting that area and seeing a move to the downside. So I'm going to set some alerts around that 159.45 area just to see if price does come up. Is that the level of interest, and are we going to get some kind of rejection there too to see some further downside? The thing is, now everybody's looking for the short trade, right? Everyone has seen this intervention. We're seeing big moves to the downside. Everyone is thinking, or everyone who's missed out on that move, are they going to get FOMO now and going to try and piggyback that move, try and see if there's some opportunity to short? So we've got to be wary of that. For one, we don't just want to short because the crowd is short in here. What is the big driver? Obviously, it's the Bank of Japan intervening into the markets. It's also the fact that we now have the US also backing that, supporting the Japanese yen too. So we've got to be a little bit careful of how we get involved in this. If the macro story remains, then yes, I do feel like we can see some further downside. If we start to see the widening of the yield spread again, maybe that's going to be something where traders see this as a really good opportunity to still be on that side of the trade. Bank of Japan have said they are going to start increasing interest rates again. They are concerned about growth and they're concerned about inflation and wage growth and all that kind of stuff. So the narrowing of that yield could come in, so that makes this carry trade less attractive to large hedge funds. But at the moment, it's still fairly wide open, so there could be still opportunity to see the market continue to drive higher here. So just be aware of that. That's the kind of downside risk to this. If you have a take a look at what's going on in the bond yield market, which highly impacts what we're seeing on the markets right now, especially the 10-year. 10-year did pull back. It got to the highs about 4.75%, did drop to 4.6, but now we're starting to see that kind of climb again. Again, seeing the dollar just supported. We're seeing the long end of the yield curve, the 30-year, trading up at 5.25%. That reached the highest levels since 2007. So we've seen a lot of sort of changes going on in the market. So keep an eye on dollar yen. That to me is a market of interest because it's a market that's been moving. I'm keeping an eye on that 159.50 handle, or 159.45 I should say. If price comes back into there and we see a rejection, could be good opportunity to get short this market. However, keep aware of the macro developments. The next part of the live stream, the big story we're talking about today, is actually going to be the New Zealand dollar. So New Zealand dollar has been performing super well recently. I've actually just show you this week's currency strength meter. You can see that the New Zealand dollar is the strongest currency out of the G10 and out of especially the G7 currencies. The weakest currency is the Swiss franc, so potentially a good pair there, New Zealand Swiss. But what is happening over in New Zealand? If I actually just bring up the economic calendar for this week, we can see that overnight overnight tonight, we have the employment change and the unemployment rate coming out of New Zealand. So if we see some numbers here, which suggest that the employment change quarter on quarter increases unexpectedly, so maybe look at 0.2% or above, then that's going to be pretty good for New Zealand dollar strength. The unemployment rate is actually forecast to come in higher at 5.4%, but if that misses to the downside and we see 5.3% as previous, or even lower, 5.2%, then there's a good opportunity that we could also see some further upside to this New Zealand dollar strength. Now, when I look across to the signals on the currency strength meter, it's very much looking at the New Zealand versus the Swiss franc, New Zealand versus the US dollar for trading opportunities right now. So if we go take a look at those charts, we can see that the New Zealand dollar is flowing nicely in a little upward trend here. The market broke down. We saw the market make a higher low, higher high pattern. We also pointed out at this point there was a commitment of trader signal suggesting that there was an extreme positioning coming from the New Zealand futures contracts, which then saw prices move higher, and it found support again, 5775 or 0 spot 5775 handle acted as a little bit of a base for price, and then with that US dollar weakness, New Zealand dollar has traded higher. It's created another new higher high now. So this is a market that's primed for me for continuations to the upside. I like the idea of targeting 5975 as the next resistance level. What we're looking at now is the fact that we might be in what's known as a phase 2 of this daily upward trend. So phase 2, it just means that price action is going against the predominant trend. Okay, it's usually the shorter part of the trend, or most people refer to it as the pullback in the trend. Now, when you look at that from sort of like a 4-hour or 1-hour perspective, look at the previous one. So when the market was trending higher between the beginning of July to the 21st of July, you can see the 4-hour was also making higher highs and higher lows in line with that daily upward trend. After that, the market made new lower lows, lower highs, and then we consolidated, right, formed a bit of a consolidation at support, and then we broke out to the upside again. So we've started to create that similar pattern. So what I want to see is, can that continue? If the 4-hour starts making lower lows, lower highs, then we could expect price to maybe pull back, perhaps back to sort of like 0 spot 58. And if it finds support there, well, that's where we could look for long ideas. Okay, so just keeping an eye on New Zealand US dollar at the moment. It looks like we could be forming a bit of a pullback, but could obviously look for that continuation. The next pair that it recommended was New Zealand Swiss. Now, if I look at this chart, you know, it can be a difficult chart to sort of trade. This chart has been in a downward trend, you know, since 2007. Right, it's been pretty predominantly to the downside. The most recent kind of downside moves came in 2021 to now. We've dropped from highs of 0 spot 66 all the way down into lows of 0 spot 45. So a very strong predominant downward trend. Now, what I would say is, you know, as of the 13th of July weekly close, we closed above the weekly 50 moving average. The last time we saw that was all the way back in May of 2024. So this trend has been predominantly down. If we look at it from, you know, trend line resistance perspective, the market has broken out of the trend line resistance here as well, which if you look at it formed on the 30th of September high, anchored to the 17th of February high, and you can see that that has been broken through. We can also see there's been like a range that price has broken out of as well. So lots of things pointing to a little bit of upside here potentially for New Zealand dollar versus the Swiss franc. But I asked myself the question, do I want to be long right now on this market? Perhaps not. You know, maybe I want to see price pull back a little bit, especially on this daily chart. Test the daily 50 moving average, maybe the range highs around 0 spot 47, 0 spot 46.80, maybe in and around that area there could be good for some opportunities to the upside. But I think if I'm going to trade anything, obviously dollar's looking a little bit weaker at the moment, New Zealand's strong. This could be a good market to take advantage of going forward with potential moves up to 59.75. So we'll move on. The next part of the stream is what I like to call the skill of the day. Okay, so the skill of the day is part of the stream where I talk about a particular skill that you can use in the markets. And today we're going to be talking about trading Fibonacci retracements after massive impulse moves. Okay, so when a market, like a central bank or sudden sort of geopolitical headline, creates a massive move, we can often see traders sort of chase the move, right? So let's use this example on US dollar, Japanese yen, right? When the market drops so much, people are trying to get a piece of the action. So they're trying to aggressively get involved with the market towards the sort of lower levels. Now, what a lot of professionals do is they look for areas of pullback, right? So we have highlighted one thing, which is the market profile, but you can also use the Fibonacci retracement tool to help you get a discount, right? That's what most traders call it, a discount on the market. So the way you can do that is by grabbing your tool, right? So I'm going to grab the Fibonacci retracement tool, and I'm going to start from the high of the impulse leg. I'm going to drag my sort of end point to the low of the impulse leg, right? And you can see that there's some levels that appear. We have 0.618, we have the 0.5 and 0.382, right? And these are important levels for the Fibonacci retracement tool. Now, what you'll see, or what I like about this particular move on dollar yen, is the fact that the 0.618 handle comes in right at the value area low of that market profile we drew. The 50% comes in right at that point of control, and the 0.382 comes in just below the value area high, which is quite interesting, because what you want to use when you use fibs is you want to use confluences. You want to make sure that when you're drawing your fib, if it lines up with an area of resistance, it adds a little bit more confluence, adds a little bit more weight to it, right? So that is how you can use a Fibonacci retracement tool to stop yourself from joining the move, right? When it's too late. Wait for price to pull back to one of these key levels, right? And if it has confluence with it, even better, okay? Now, there's an old strategy that I used to use when it comes to Fibonacci, and I would use limit orders on the key levels, targeting what they call projection levels, right? So you can also see I have other levels below. So I've got the 127.2 and the 161.8, right? Those, the 161.8 is known as the golden fib, and the 127.2 is a sort of target for most traders. So what I used to use as a strategy was I'd use a sell limit order in this particular example at the 618, put my stop loss above the 236, and I'd try and target the previous structure low, or I'd try and target that 127 extension, okay? And then I would set another one at the 50%, same stop loss, same target, and then I'd set a third at the 38.2, same stop loss, same target, right? Now, obviously, if you're in a strong trending environment, you would usually hit the 61.8 retracement and the market would continue lower. If you're in a sort of semi-strong environment, you've got the 0.5, that would also be a good trigger point. If you're in sort of a deeper correction, you could get that 38.2 trigger, and if it does go, then there is a strong reward to risk ratio. But the likelihood is that you're going to get less of an impulse to the downside at that point when you hit that kind of deeper retracement. But the key levels that you need to look for are the 61.8, the 0.5%, the 38.2. And what you're looking for is, when you draw that tool, is that a good area to look for continuations of that impulse move, okay? It's trying to prevent you from trying to chase that move, because if you constantly draw in your Fibonacci retracement, you're waiting for price to come back and almost give you that sort of discount zone on your trade, which automatically gives you a better reward to risk ratio. Now, fibs, I don't use too often anymore. I use market profile a little bit more in my own personal trading, but they are very, very handy tools for you to use. I used to love using them on a weekly chart. You know, when you see a nice weekly impulse leg, I would grab my Fibonacci retracement tool. So for this example here, on this upward trend of dollar yen, you could go from the swing low to the swing high, look at those discount areas and look for opportunities around that. So you can see, you know, on this particular one, if you would buy limited the 618, the 0.5 and the 38.2, they all would have hit trigger. They would have all been good trades to enter, and they all would have hit the 127 extension. So there would have been some massive gains there. If we look at this previous leg of the impulse, we can highlight the swing low to swing high, and you can see on this one in particular, it only reaches the 618 and the 0.5% before moving higher towards that 127 extension. So like I said, the deeper retracement is less likely to trigger. When it does, it can create good moves, but it's also less likely to hit those targets as well, because of the how sort of strong the pullback has been. But very, very handy tools to use when it comes to waiting for price, and giving you a little bit more discipline. Instead of trying to chase the move, draw the fib tool, wait for price to come to a discounted area before trying to make any kind of trading decisions. So thank you for watching the stream today. Hope you enjoyed it. If you did, leave it a thumbs up, subscribe if you're new around here, and I'll speak to you very, very soon.